So I try to do these videos every single month talking about two undervalued stocks to consider for a specific month. A lot of you really like this series that I've been doing pretty much since February. We had pretty good gainers in this series. We had also some losers, but it wasn't, anything crazy. And it's becoming harder and harder to find undervalued stocks to buy whenever you have the market going up, especially when you have the Magnificent Seven. Pretty much they're starting to carry a lot of the other stocks that haven't been doing very well. But I've been trying my best to find these stocks. Sometimes I find them, but they move too quickly before the beginning of the month, which is why I try to share them on Twitter. For example, RTX Corporation, which was Raytheon, it sold off 14% on earnings for no reason, for some kind of a reduction in free cash flow, 500 million reduction, and some engine problems, and the stock sold off $20 billion off its market cap. To me, it didn't make any sense, but it's up over 6% since I posted this. So sometimes it's hard for me to do them, but in this video I found two undervalued stocks in this market to talk about. One of them I talked about before, so sometimes I might be a little bit repetitive, but I also have a new stocks that I haven't talked about before, and most people actually don't even know this company exists. Maybe you've used the product, but you actually don't even know it exists. And it's much better than the Magnificent Seven stocks. It has a lot of growth and it's much cheaper. So I believe a lot of you are really going to enjoy the second pick, but I'm gonna start with the first one in this video, and this is the one that I talked about before. I'm not gonna put a lot of time into this, but this is BJ's Wholesale Club. And I know a lot of you like to make fun of the name in the comments. I mean, I'm fine, I don't really care. I'm just trying to focus on the company. This is just the way they named it, which I don't mind at all. But the company is starting to move. I mean, the stock is it pretty much made a new high. It's starting to break out. It made a massive gap down on earnings. For, in my opinion, it was short-term noise, some missing on comp sales, and a few other things. And all the retailers had a record year in 2022. Ulta Beauty, BJ's Wholesale Club, a lot of them, Dollar General, a lot of them had record years in 2022. I mean, it's hard to compare those kind of years to 2023, and this is what's happening to these retailers, and they are going down a lot. But a lot of people tell me, how could you look at BJ's and all these kind of company, they're all missing on comp sales, they're all having inventory issues, all of them are not doing very well. Well, this is the best time to be buying them. The best time to be buying them is not when they're doing very well and everyone loves them and the company is sitting at 52-week highs. The best time to buy them when most people believe the retailers are dead, or retailers, they're just, Amazon is taking over, no one's gonna go shop there anymore, inventory issues, missing on comp sale. This is when the time that you should actually be buying them. This is when they bottom. They bottom when no one is expecting them to. But most investors feel better buying a stock when everything is going well. Even though it's the same stock, if they have temporary issues, this is the time you should be buying them. Something like, Raytheon, some, engine problems. The company has pretty much twice the market cap in backlogs. I mean, the company is not going anywhere, and it sold 15% on earnings. I mean, I couldn't believe what I was saying with this market, and it's just presenting buying opportunity one after the other, and it's up to you to actually, have the guts to, buy it when most people actually have a different view that the company is dead or something is wrong with it. But BJ's Wholesale Clubs, they own those kind of wholesale clubs, kind of like Costco and Sam's Club, mostly on the East Coast, over 237 clubs. This is not a small company by any, metrics. They have over 6.9 million members, I believe. So they have a lot of members. They have over 237 wholesale clubs. A lot of you might tell me, why would you look at BJ's? BJ's has no chance in comparing or in competing against Costco, Sam's Club, Walmart, Kroger, and all these kind of things. Well, they actually been doing that, and the numbers prove that they've been doing something right. But the main difference between Costco, Sam's Club, and BJ's is BJ's has kind of broader assortments. They have smaller pack sizes, which if you've been to any BJ's, and I have been there, I mean, they have smaller bulk sizes, smaller items. So it's not only for big families like Costco and Sam's Club. Even single people can go to BJ's, or maybe a smaller family, maybe just a couple. They can actually go to BJ's and buy everything they pretty much need. They don't need all the huge bulk items and buy all this kind of extra stuff that they don't actually need. And it's just BJ's is more convenient. There's a lot of traffic at Costco and Sam's Club. A lot of people are getting sick of it. There's they're signing up for BJ's. The numbers are showing that. So this is the main, difference between them, is that, they just have smaller bulk items and they have faster checkout times, and it's just more convenient. And now even if you go to any of the BJ wholesale club, they're starting to have more and more traffic, which is pretty interesting to me. But one of the numbers that proves that BJ's has been doing something right is actually the renewal rate, which touched a record high of 90% in fiscal year 2022. It was 83% around 2014, and it went to 85, 87, and now it's over 90%. This is because BJ's is replicating what Costco did in terms of membership value. For example, they have those credit cards that they have. They take all the profits and they're reinvesting it in membership value to bring deals to kind of customers for them to keep coming back. And they do the same things with the gas profits. And they did take a hit on the gas profits, actually, comparing it to 2022, because the spreads were much higher. But in my opinion, it's just all short-term noise for the company. Wall Street worries about a quarter or two. But if you have 5 or 10 year kind of horizon with a lot of those stocks, I think, a lot of them are going to do amazing things. And the company is still growing, rapidly, in my opinion. 5 years ago, they were just opening 1 new clubs or 2 clubs every single year. Now they opened 9 clubs in 2022, all in new states and in new markets, and they have been having huge success in those markets, which actually shows you that BJ's can potentially expand beyond the East Coast. They expect to open 11 stores in 2023 and over 10 new stores every single year for the foreseeable future. And the company does not pay a dividend. They do a little bit of buybacks, but most of the profits, they're reinvesting it into more stores, which are going to get more free cash flow, and then they take the free cash flow and reinvest it again. And this is how you have the snowball effect, and how the company keeps growing. And the more BJ's grows, the more bargaining power is going to have over the kind of merchants and all the people that they buy things from. They're going to have better and better deals, which is going to make them actually more attractive to a lot of the customers. But if you look at what BJ's is trading at, it's trading at 16 times forward earnings. When I talked about it, it was at 15 times. But now it's sitting at 16 times forward earnings, which is much lower than the historical average. The historical average is around 18 times. But the company is pretty, undervalued. If you looked at it, pretty much every single day, the volume compared to the average volume, it's not too high. Most people don't even know that this company actually exists, even though it's an $8 billion market cap. And the market has started to realize the value for BJ's. It was sitting at 20, 21 times earnings, which I believe is fair value for this kind of business model. But it went back to 16 over a sell-off that has not been warranted, in my opinion. It's all short-term noise. But if you compare BJ's to something like Costco, which is a hard comparison, I know, but it's just the same business model. Costco is trading at 36.5 times earnings, while BJ's is trading at 16 times earnings. Now, I don't know about you, but to me, this is a massive gap that I believe BJ's in the future is going to trade around 20 to 22 times earnings. I'm not saying BJ's is going to become like Costco, even though BJ's has higher margins than Costco in a lot of the other areas. BJ's is much younger. It has longer runways than Costco. It has higher growth potentials than Costco, but it's just trading much lower. I don't know why that would be happening. Maybe because Costco has higher comp sales, or it's just a more well-known company with higher renewal rates. But in my opinion, this is a very wide gap, and I personally believe BJ's is eventually going to get back to 20 to 22 times earnings and stay there for the foreseeable future, which is why I made a very basic calculation with BJ's, and I've done another one in my old video, which is why I'm trying to keep it quick for this video. And this is pretty much, I took the GAAP EPS, I put in 12% on the GAAP EPS growth, because the company is targeting low double-digit EPS growth for the next pretty much 5 or 6 years, which would be around 12%. So I just took the numbers, I put in 12% for the next 5 years. I got $6.63 per share, and you could time it by 20 times earnings, which in my opinion, 20 times to 22 times is fair value for BJ's. I don't believe it's gonna be sitting at 16 times earnings for very long. I have seen such things play out before. Whenever you have such a huge sell-off on pretty much no news, it's not warranted, it's nothing crazy changed with the runways, then the market's gonna wake up and then it's gonna go back to 2021 21 times earnings. So this is my thesis on the company. But if I use the 20 times earnings, that would be around $132 per share. $132, we could divide it by $66 per share, which is where it's trading now. This is pretty close to 100% on the upside over the next 5 years, which is around 15% compounded every single year for the next 5 years. Now, I have to remind you something, that if you ever try to do this on Costco, on Walmart, and all these kind of companies that have long runway, especially Costco, you will never get 100% over the next 5 years. Every time I run those numbers, it's almost 40, 50, 60% over the next 5 years. It's never 100%. But BJ's, you're getting a very long runways with growth and a pretty predictable business model, and 100% upside over the next 5 years. I still believe the company, is undervalued. I think, when the change in sentiment happens, the gains are going to be much faster than 5 years. I think it could go up, 15, 20% within months, in my opinion, if the market started to realize the value. And if maybe they have 1 or 2 good quarters, I think it's going to get back to 20 times earnings. I could be wrong, not financial advice, but this is my thesis on the company. And I just think no matter how you look at it, the company, in my opinion, is still very, very undervalued. Now, another stock that I haven't talked about before, and most of you don't even know that this company even exists, and this is a stock called Evolution Gaming, EVVTY, on the OTC exchange, but the main listing for the company is in Sweden. But if you're outside the United States, you could either buy it, I believe, on the German exchange, they have a listing, but they also have one in US dollars on the OTC exchange, and it also has plenty of volume, so it's not illiquid or anything crazy. Now, Evolution Gaming, this is something I posted on Twitter, and I said that the net income for the company is up over 80% pretty much since 2022 or 2021, over 80%, but the stock price is pretty much flat. And this is something else that actually happened with Visa and a lot of those other stocks, and this is mainly because the company was trading at a very high multiple, and it had to take time to grow into the valuation to kind of become pretty close to fair value. And I believe the company stayed flat for around 2 years, and it grew net income 80%, and it kind of grew into the valuations that it went to because it has been a good performing stock. It was sitting at 111 pretty much, and it went around 1700 at its high. So it has grown very quickly, and it took time to grow back into the valuation. But Evolution Gaming pretty much operates within the online casino, gaming market. A lot of the live casino stuff, RNG casinos, which is more on slot machines, but it's mostly the online casino stuff. And if you look at the gaming market in 2022, online casino is only 23%. Land-based casino is still over 77%, but they have been declining. The land-based casino is down 4.7% from 2018 to 2022, but the online stuff, especially the live casino, is up more than 21.5% from between 2018 to 2022. Now, I know a lot of you are going to have problems with this company because it's in gambling and you have some kind of, some feelings around this. And I understand. I mean, you don't have to, look at it. You can just watch the video and move on. I understand if you have, certain sayings where you don't invest in these sin stocks or whatever people call them. For me, I don't really have this problem. But if you have it, I completely understand. But in terms of the market, it has been growing very, very rapidly. Now, the main way Evolution makes money is it collects a fee from the gaming operator. For example, something like MGM or Caesars or a lot of those kind of, gaming operators that they have those online-based casino. Evolution Gaming develops the game. They do all the, back-end stuff, a lot of the front-end stuff. And the gaming operator is the kind of operator that runs the game. And the end user pays the gaming operator to gamble and play things online. And then the gaming operator pays, variable commission and other kind of fees to Evolution Gaming for the platform. So Evolution Gaming owns the platform that, Caesars or MGM actually operates, and this is the platform that you could actually gamble on, but it's all owned by Evolution Gaming, which is a pretty amazing business model, and I'm actually going to show you a lot of the numbers on why. Now, Evolution Gaming is a leader pretty much in this market. It has a first mover advantage. It has a lot of staff, a lot of employees, a lot of expertise within this industry, because the company still have over a 40% market share in the pretty much regulated markets, which is in Asia and Europe. Some states in the United States, like 5 or 6 states, you could actually play online. It's not as popular in the United States as it is in Europe. Europe is a much more mature market. You could see it from the revenue. Europe and Asia, North America, it has been growing, but not as it should. And whenever more states open up, online gambling, a lot of those other things, then, it could be a massive revenue generator for Evolution Gaming. But they have over a 40% market share in those markets. So you could see that Evolution Gaming has a competitive advantage. And I read a lot of things around the company that they actually have a lot of staff that monitor a lot of the cheating, because you could somehow hack the game on some APK or something, some kind of a hack, and you could kind of take money or kind of change the odds and a lot of other things. And Evolution Gaming monitors all of that stuff, and they have a lot of experience, which is why they have over a 40% market share in this area. And the beautiful thing about it is, let's assume some new states kind of open up a legalization, or some kind of new country, and you have a gaming operator like MGM, which already has a partnership with Evolution Gaming, and let's assume they move into a new state, then they're gonna tell Evolution. So Evolution doesn't have to pay the advertising. They don't have to kind of go try to find growth. They're gonna grow as long as their operators are actually growing, which is an amazing business model. If you look at the income statement, it has still growing pretty amazing, over 20%. I mean, most of the expenses is personnel expense, and then a few others. Operating profit 281 versus 214. Profit after tax is 264 versus 200. So the company is still growing rapidly despite it being more mature. And the balance sheet is also pretty amazing. They have around 1.1 in total assets. Pretty much their entire liabilities, the non-current and current liabilities, can be covered with just pretty much their current assets. So the company has pretty much no long-term debt, nothing major, and they have a lot of cash and shorter-term investments that they can actually use and pay their entire debt, which the balance sheet is amazing. They have over a 40% market share. The company has been growing rapidly. You won't even find it in the Magnificent Seven. I mean, it has been growing 53%, 90% in 2021. 36% in 2022, 25% now they're growing in 2023, and over 19% in 2024. And in my opinion, they're going to keep growing 20% for years and years to come. And if more states and more new markets open up for legalization, then the company can grow potentially even more after it has been growing even 50 or 90%. I mean, you're not going to find it in any of the Magnificent Seven. If you look at the return on capital, it has been over 50% since pretty much to 2019. And then they made some acquisitions. Some of them did not work out, which is why the return on capital dropped. But now it's recovered back to 25%, which is a very high return on capital. If you look at the net income margins, which I like to compare them, it's over 58% net income margin. 58%. I mean, if you just look at, it's not the best comparison, but if you look at all the stocks that people are excited about in the Magnificent Seven, something like Apple only has 25% margins. Microsoft only has 34% margins. I mean, no one of the Magnificent Seven can compare to Evolution Gaming's net margins of 58%. This is massive, but most people don't even know that this company actually exists, which is astonishing to me, in my opinion. And the best part about it is that if you look at everything I showed you, 40% market share, high returns on capital, growing 20 to 25%, 56% net income margins, and they have all these things, a good balance sheet, no crazy debt. I mean, how much would you believe this company is trading at? Maybe, I don't know, 30 times earnings, 35 times earnings. Well, it's nowhere close to that, because the company is trading at 20 times earnings. Now, to me, this is an amazing value proposition. I don't even have to do a valuation model on this thing. I mean, they also pay like a 2% dividend that they've been growing, but the company is growing 20%. No long-term debt, high return on capital, 57% net income margins. It has a 40% market share. They have some kind of a moat because of the staff and because of the experience that they actually have, and they have been growing for a very long time, and they have amazing management at 20 times earnings. In my personal opinion, the company is very undervalued. I mean, the mean was 29 times. And in my opinion, the company is priced like it's not going to grow anymore. I mean, like if it's just going to grow 5 or 6%. And even that, with 57 or 58% net income margins at 20 times earnings, the company is still very undervalued. And I think one of the reasons it's undervalued is because it's not sitting on the US exchange. I mean, if this was a NASDAQ stock, I mean, I'm pretty sure it would have been 25 or 26 times earnings minimum, but it's sitting on the Sweden exchange, on an OTC exchange, which is another reason why, in my opinion, it's sitting at 20 times earnings. But it could be a value trap, although I'm not seeing it because the company is still growing. It grew in the last quarter. A lot of interesting things are happening. So I don't believe it's a value trap, although it's possible, but it's a very, very interesting company to research if you're interested in more of those undervalued kind of names that no one heard of, especially a lot of the small and the micro cap stocks. They are profitable with high insider ownership. We do a lot of that stuff in my own investment group, which if you're interested in checking it out in the description. So no financial advice, of course. Thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.